Hello everyone. In this video I'm going to begin going through the Topic 12 Equity Valuation Model Notes. We're going to start by talking about mispricing in the market, and then go through and talk a little bit more about comparables in this video. And that's where I'll stop with this video. The next video will begin the absolute valuation models, which are the dividend discount models and the free cash flow models. So let's go ahead and get started. So you'll notice there's a lot of text in these notes and not a lot of places to write notes, and that's might make the video a little boring. I'll try to not just read all of the notes and explain what's going on with the text and with the different formulas that you'll see. When we talk about valuation, when we value a stock, what we're usually trying to do is determine its intrinsic value. So the intrinsic value is based on the fundamentals of the firm and what the value of the future cash flows are today to investors when they're discounted back at the appropriate required rate of return. So we oftentimes will compare that intrinsic value versus the market price to determine if the stock is undervalued or overvalued, or if it's correctly priced. If the market is efficient, then the prices of the securities that we're valuing should be correct. Okay, so the abnormal return, or the alpha, is the excess risk adjusted return. We've gone through this in class before. Mispricing is the departure of the market price from the perceived intrinsic value. And there's two sources of mispricing. So what this says is the degree of mispricing is the estimated intrinsic value. That's the value that we would come up with when we value the stock, and minus its market price. And so this mispricing comes from two different things, V minus P. So V minus P means that for this stock, the market is inefficient, that the market price doesn't reflect the actual intrinsic value. Sorry, true intrinsic value, we'll say there. And that's what analysts are looking for. They're looking for places where the true value of that stock is different than the market price. So if the true intrinsic value of a stock is greater than that market price, we would expect the price to adjust up as more people realize that and demand for the stock increases. Or if it's less than the intrinsic value is less than the current market price, we'd expect the price of that stock to go down. And we can make trades based in either case to take advantage of that mispricing and gain an abnormal return. The second type of pricing is ones that we're hoping isn't true, and this is the EV, estimated value. All right. The second one is the one we hope doesn't exist, and that is where the estimated value, the value that we calculate or the analyst calculates, is different than the true intrinsic value. In this case, the estimated value was wrong. For some securities, EV minus P is persistent. Analysts often look for a catalyst that will cause the market to reevaluate a company's prospects. If a stock is undervalued, then if the price converges to the estimated intrinsic value, the investor will receive excess risk-adjusted returns. For some firms, even if V minus P is the source of mispricing, so the market price doesn't match the intrinsic value, sometimes it might not ever actually achieve that, especially if it's a small firm that's thinly traded. The market may never become efficient for that stock. In some cases, companies will do things in order to get the market to realize the value of their stock. A common thing for companies to do, at least in the past, has been to spin off sections of their company. And when that happens, then both companies then, the original company, the parent company, and the company that spun off, get reevaluated by the marketplace, and companies will do that to get the value of their firms reevaluated. They'll engage in some corporate event in that way if they feel like the market is undervaluing the stock. Valuation by comparables. So price multiples are ratios of the stock price to some measure of fundamental value. The intuition behind the price multiples is that they tell the investor what one share buys, whether it's earnings, cash flow, net assets, or some other measure of value. So the common ones that you might see are PE, and let me just explain, put in what these are. PE is the price to earnings ratio. PB is the price to book, also known as the market to book ratio. And PCF is the price to cash flow ratio. So the PE ratio is probably the most common one that you'll see. This one's been around for a long time, and partially because it only requires an investor have access to the income statement of the firm and the current market price. Things like the price to cash flow ratio would have been more difficult to calculate 30 or 40 years ago. Well, 40 years ago, because companies didn't release their statements of cash flow back then. And price to book has become more popular since the early to mid 1990s, where the market to book or the price to book ratio has become more relevant. So a lot of people still use that price to earnings ratio, and we're going to work through some examples of why that might be here in a few minutes. Enterprise value multiples are ratios of total firm value, not just the price per share, but the total firm value divided by a measure of fundamental value, such as earnings before interest and taxes, sales, or operating cash flow. I also have used enterprise value multiples in the past to value firms. If there is something about the firm that the firm does, essentially they do one thing and it's divisible. So, for example, I've used this to value cable companies in the past, where I've taken the enterprise value of the company, which is its market capitalization plus its interest-bearing debts. I've divided that by the number of, in the case of the cable company, the number of subscribers that they have, to assign a value to each, the average cable subscriber. And I've seen this done, and that kind of technique used whenever a cable company will divide up, like Time Warner, divided up and essentially sold subscribers to other cable companies, and that's how it was priced. This is how many customers that you're getting from us, and this is the price per customer. You can also use this with things like trucking companies with the number of miles driven, airlines, number of passenger hours flown. So anything where you can divide it up based on an individual metric of what the company does, you can use that enterprise multiple valuation for. The method of comparables compares the price and enterprise value multiples of the subject firm with those of similar assets. The similar assets are referred to as the comparables, comps, guideline assets, or guideline companies. For example, we could compare the PE multiple of a subject firm with that of firms that are comparable in terms of risk, profitability, and growth. The comps could be a similar firm or a group of firms in the same industry. If a firm had a higher PE than the comparables, it would be deemed overvalued. Note that this assumes the comps themselves are correctly valued. So the idea is that we would take the multiple that we're using, PE, PB, price to cash flow, or an enterprise multiple, and compare it to those of similar companies. The economic rationale for the method of comparables is the law of one price. Identical assets should sell for the same price, and similar assets should therefore sell at similar prices. Some rationales and drawbacks. PE is the most widely multiple used in valuation. Following are the reasons for its use. Earnings power as measured by the denominator, earnings, which is earnings per share, is the primary driver of investment value. Whenever companies release their earnings per share, quarterly earnings per share, if it's a surprise for the market, the stock prices of the firms can move dramatically. PE is widely recognized and used by investors. PE differences are significantly related to long-run average stock returns according to empirical research. So there's been a lot of research done on this, and the price to earnings ratio of a firm today is significantly related to its stock returns in the future. So a high PE can be indicative of higher returns in the future. Potential drawbacks to its use come from the use of earnings. So if you have a company that has negative earnings per share or very low earnings per share, it's going to give you a price to earnings ratio that doesn't make sense. It'll give you a negative price to earnings ratio if the earnings are negative. If they're very small, if the earnings per share are very small in an absolute term, either positive or negative, you can get a huge price to earnings ratio, and one that really doesn't make sense. The transitory portion of earnings can be difficult to distinguish from the permanent component that is important for valuation. So in the past, when I've taught valuation classes, this is really an important thing where we'll go through and we'll look at the earnings for a firm over long periods of time and establish which ones what part of those earnings are permanent. In other words, it's what they do, what the company does day in and day out. It's their operations, and that's the earnings that we're concerned about. If they have small things like, for example, I was just looking through some energy companies for another class for us to analyze, and a lot of these energy companies in the last year have had to mark down the value of some of their assets, and so that's kind of transitory. That one time, hopefully one time, effect on earnings is transitory and not permanent. And so, in order to really use price to earnings well, you have to be able to take out those little pieces of earnings that aren't permanent for the firm. Managers have discretion in determining reported earnings, which lessens the comparability of PEs across firms. They can do this by using accruals. They can do this by timing when sales occur, whenever product is delivered. I worked for a company where in my area, the manager did do that. He timed out when we would actually deliver goods in order to make our sales and our earnings look very smooth. So managers can certainly affect reported earnings and impact that PE number. Limitations of book value, so price to book ratio. Book values are usually based on historic cost, not current value. And so when we look at a financial statement on a balance sheet, what we're seeing there primarily in terms of the numbers are based on the historic cost. Now, things like accounts receivable and maybe in inventory, those should be pretty up to date. But when we get into things like fixed assets, you might have a building on the books that was bought 30, 40 years ago, and it's on the books at its historic cost. Okay, its current value is probably much higher than the value that's actually on the books. Now, that's one thing to keep in mind when you look at the price to book ratio. So a firm, if you had two identical firms, except for one was much older and had purchased its fixed assets long ago, the one that's much older is going to have a higher price to book ratio because the book value of its assets are lower. The floor of a firm's stock price is not its book value of equity, but based on its liquidation value. So in other words, the liquidation value of the firm can't be more or less than the book value of its assets. Replacement cost of assets minus liabilities is also a measure of firm value. Based on Tobin's Q, if the market value of the firm is much higher than its replacement cost, then competitors will enter the market and drive down value. If the replacement cost is less than the market value, then the management has destroyed wealth. So we're going to focus on price to earnings because it is the primary one that people use. There's many ways to calculate the price to earnings multiple. The price to book is a little bit more straightforward because we're going to look at the book value of equity for that, and you can measure that once a year or on a quarterly statement. But earnings is kind of strange because we can look backwards or we can look forwards with earnings, or we can look at a 12-month period in between, and we're going to go through those different options when we talk about price to earnings multiples. So when calculating the PE multiple, the stock price numerator is unambiguous for publicly traded companies. It's the stock price that's you look up online. The earnings denominator can generally be characterized in two different ways: the time horizon over which it was measured and the adjustments to accounting earnings required so that PEs are comparable across firms. Okay, so the time horizon for earnings results in two broad definitions of the price to earnings ratio. The trailing PE, and this is also referred to as the current PE, which uses the past 4 quarters of earnings, referred to as the 12-month TTM EPS. So when you see TTM, it stands for trailing 12 months. If you see LTM, it has a similar meaning. It means last 12 months. And you'll see these a lot when you look at financial statements or analysis for a company. The forward PE, also referred to as the leading or prospective PE, uses next year's expected earnings based on analyst or database estimates. When I look at reports, I pretty consistently see the forward PE as the one that's being used. But if you're comparing PEs across firms, you just want to make sure both the same definition is used or across the different firms. Later on, I'm going to show you how to use the PE ratio of a firm for the horizon or the terminal value for a stock to determine what that value will be. But for now, we're just going to consider it as a comparable measure. The forward PE is preferred over the trailing PE when the trailing earnings are not representative of the firm's future. The trailing PE is preferred when forecasted earnings are not available, which is often the case for small firms that are not widely followed. If earnings are zero or negative, the analyst may use a longer term or future positive earnings figure. Regardless, the analyst should use the same definition of earnings when making comparisons across firms. So I'm going to give you an example. I'm going to give you the example of a forward PE. So here's the information that we have, and it's down here below, but essentially we're considering in this example that the current, just put it in here, it is currently November 2018. And we're going to use this information to calculate different earnings per share and then different price to earnings ratios. Forward PEs are often favored over trailing PEs because they are forward looking. There are many different interpretations, however, of the forward earnings figure. Forward earnings could be the EPS for the next 4 quarters, the EPS for the next 12 months, or the EPS for the future fiscal year. The future fiscal year may be defined in different ways. If the time of prediction is between fiscal year ends, the fiscal year can be used can be the current one, for which some time has already elapsed, or it can be for the next fiscal year. So the example here illustrates various calculations of the forward PE. We will assume the PE is calculated and the stock price is recorded in November of 2018. We also assume that the fiscal year end is the calendar year end of December. Now, I'll warn you that as you look at companies, oftentimes the companies do not have fiscal year ends in December. So, for example, Walmart's fiscal year end is the end of January. And it makes sense because they don't want to put their fiscal year end at a time when they're doing a lot of business and things might not look normal for the company. So, Walmart does a lot of business around the holidays, as many retailers do. And so, oftentimes, retailers will not put their fiscal year end in at the end of December with the calendar year end. A lot of nonprofits and government organizations have their fiscal year end during the summer. So Washburn University, for example, our fiscal year end is June 30th. And that's done because during the midst of an academic year, there's a lot of transactions going on. There's a lot of business going on. It's maybe hard to get firm numbers on everything. And so it's easier to do that in the middle of the summer when there's not so much going on, when we know it's been, the end of the academic year has transpired, and we can look at things like, if students withdrew from classes and got some refund, we can see that. We make sure all the purchases are done. So at the end of the fiscal year at Washburn and most universities, they'll go through and they'll say, here's how much money we have left in budgets. What do you need? Or if if you're going on a trip, or if you've been on a trip recently, we need to get the money, the bills in for those trips so it counts in the right year. That would be very hard to do during the middle of a school year. And so fiscal year ends are often placed at times when it is easier for the business to provide the information for those annual reports. So the first thing we're going to do is calculate the forward EPS and price to earnings ratio using the earnings per share for the next 4 quarters. The next 4 quarters are defined here as the current quarter, the fourth quarter of 2018, plus the first 3 quarters in 2019. So the resulting earnings per share, there we go. The resulting forward earnings per share is going to be the next 4 quarters. So it's going to be Q4 2018, Q1 2019, Q2 2019, and Q3 2019. So I will calculate this in Excel because it's easier for me to pull up than getting a calculator out. So I have 0.35 plus 0.43 plus 0.48 plus 50 cents per share. And that gives me a value of $1.76. The price to earnings ratio is the stock price today, as of whatever day we're doing it in November, is $20. So the price to earnings ratio is 20 divided by $1.76. So 11.36. Under the second method, the EPS for the next 12 months is the weighted average of the current year and next year's forecast. There's just 1 month left in 2018, so we weight the 2018 fiscal year by 1/12 and the 2019 fiscal year by 11/12. So that's what I'll do here. So our first is going to be 1 divided by 12 multiplied by our estimate for 2018 of $1.10. And then in our second case, we're going to take 11 divided by 12 because 11 of the months in our year are from 2019 in the future. We're going to multiply that by $2 per share, which is the estimating earnings per share for that year. So the forward earnings per share in this case is 1.925. And the resulting forward PE is $20 divided by 1.925. Or 10.39. When using the current fiscal year as the future fiscal year, we would use the 2018 EPS of $1.10. And again, this is considered a forward PE because the year isn't over yet, resulting in a forward PE of 20 divided by $1.10, or 18.18. Then finally, using the next fiscal year end, or fiscal year as the future fiscal year, we would use the 2019 earnings per share of $2. The resulting forward PE is 10 because it's $20 per share divided by $2 per share. So what I want you to notice, other than just how to calculate them, is that we get very different answers for the forward PE: 11.36, 10.39, 18.18, which is our biggest one out there, and then finally 10. We get different answers based on the method that we use to calculate it. So it's important, again, when you're looking at information on firms and comparing firms, to make sure that the firms are, the forward PEs are calculated in the same way. So notice that the PEs from the two methods are quite different. If a firm's earnings are volatile, the analyst may want to use a normalized earnings figure. So what a normal earnings figure is one that kind of makes sure to take out any non-recurring income for the firm. And then if, again, even taking that results in a very volatile price that moves up and down quarter to quarter and year to year, or I should say earnings value that moves around a lot. It's also, you can also consider looking at maybe an average earnings per share, or foregoing using PE at all because it's just not a very good choice in that case. The next thing I want to talk about is the present value of growth opportunities. The value of a firm can be thought of as the value of the firm without earnings reinvestment plus the firm's present value of growth opportunities. And it's important, this is an important topic because sometimes you've got a firm that doesn't generate much earnings now, and if you're looking at this firm, you might, a lot of the value associated with it is not what they're actually doing now in their performance today, but what the possibility is for the future. And probably the most well-known firm that I would put in this category is Tesla. Tesla is not a very good looking firm right now, and yet it has a pretty high stock price. Let me pull it up here. So Tesla has a stock price of $729.83. We can't translate that number into anything very meaningful because that number is going to, can be changed by the number of shares outstanding. So let's just look at some of the information here. It's got a market cap of right at $135 billion. So this is a very large firm. It has an earnings per share negative, and this is, so we talked before about how these are calculated. This is the trailing 12 months. So this is the last 12 months of earnings, negative 4.92 per share, which isn't good from an investor perspective. The analysts tend to not think very highly of this company because it says it's got a one-year target estimate of $452. It's currently trading at $729, so that's not great. PE ratio is NA because it's the price divided by a negative number, which would just give you a negative PE ratio, which economically, it doesn't make a lot of sense. So this is definitely a firm that its value, $135 billion, isn't based on what it's doing right now, is not based on what the company and its performance right now, because it's had negative earnings. Its revenue is growing pretty well, but not terribly great between the end of 2018 and 2019, but it grew a lot in the previous years. So the valuation of this company is primarily based on its growth opportunities and not what it's generating today. Okay. So the value of a firm can be thought of as the value of the firm without earnings reinvestment, plus the firm's present value of growth opportunities, also known as value of growth. Consider a firm with a 10% required rate of return on equity. If the firm has new projects available with returns greater than 10%, the firm should invest in them because they will generate positive net present values. If, on the other hand, a project's return is less than 10%, the firm should pay all earnings out as dividends. In the latter case, the firm should pay out all earnings as dividends, and earnings will be constant in perpetuity because the firm does not reinvest in its operations. And I don't know the current situation with Capital Federal Bank, but for a while, up to a couple of years ago, I know at least, their goal was zero growth. They did exactly what's being described here. As earnings came in, they paid them all out. They didn't want to grow the bank because it would have increasing the size of the bank would have put them under new regulations that are based on the size of a bank, would have added a lot of additional costs for them. And they looked at that situation and said, it doesn't make sense for us or our stockholders to get larger, because then our profitability will shrink, and possibly the value of the company would actually shrink by growing larger. And so, if they have chosen to get bigger now, that has to be the result of making sure they get large enough, that they grow enough to overcome those additional costs associated with the higher level of regulation. So some companies do actually have a goal of zero growth, and that is the case here that I'm describing here with the no growth value per share. And it's calculated as the earnings because, remember, the firm's not reinvesting their earnings, they're paying everything out, so earnings aren't expected to grow. That's why there's no subscript there on the E divided by RS, required rate of return on equity. So if, however, the firm does have positive NPV projects and we were to discount those future cash flows, we would arrive at the present value of growth opportunities. In the formula above, if we assume that the price is equal to the value, in other words, the firm is correctly priced, then we arrive at a calculation for the PVGO. Essentially, we assume that the stock price, the market stock price, reflects a no growth value for a firm plus the present value of growth opportunities. Firms with greater opportunities and those that have greater flexibility to modify projects through time, these are referred to as real options, will have a higher present value of growth opportunities. The latter value arises because real options allow the firm to respond to changes in the marketplace. We don't really go through real options in this class. You may in another class. But real options do really just represent opportunities. We can price those opportunities using, and the next topic we're going to talk about in this class is options, financial options. We can price opportunities for a firm as an option, and they're referred to as real options rather than financial options. But we can determine the value of those options. And so if you've got a firm, what this is saying is that the value of a firm is equal to its current earnings, that assuming that they're not reinvested, plus the present value of its growth opportunities. So in a case like Capital Federal, and I mentioned, I looked at their stock today actually, and it's in the same price range as it was when I valued them a couple of years ago. Their value was strictly E divided by RS. They paid out all of their earnings as dividends, and so it was a perpetuity. You could take their current dividends and divide it by the required rate of return for their stock, and you would get the stock price for the firm. So the value, their PVGO, was probably close to zero. Tesla is the other extreme. They're not generating any earnings. So this first number here would actually probably be a little negative because their earnings are negative, but we would assume that it's just zero. Okay, there's no value is being assigned to the current earnings because they're negative, and so the entire value of Tesla is based on the present value of growth opportunities. In general, firms where the value, primarily the value that we estimate and the value we see in the marketplace, if it is weighted heavily on this first number, they're generally pretty safe firms. The value in terms of pricing, the value is directly associated with the earnings they're currently earning for the firm. If a firm's value is heavily weighted on this present value of growth opportunities, that's a little riskier situation, and some people refer to that as thesis investing. In other words, you're not buying what the company's currently doing, you're not buying their current earnings, you're buying a thesis, an idea about the company and where they're and how they're going to grow in the future. And that can be a lot riskier. And there are some financial pundits that warn against heavily investing in companies that are primarily their value is associated with these present value of growth opportunities, because if things don't pan out, and honestly in a lot of cases it's things that we can't even predict about the company yet, if you're assigning a lot of value to that can go away very easily. So for example, with Tesla, a lot of value, at least to me, seems to be assigned to the wonderful things that Elon Musk might be able to do in the future. So we've seen them come out with tiles that are solar panels that look really nice but really haven't taken off yet, with power cells for people's houses. Again, these aren't cars, and those opportunities in the future. At the same time, General Motors and Ford and a lot of companies are switching over and planning on building completely electric cars. So there is a lot of opportunity there with Tesla. There's also a big risk that they're just going to get drowned out by other car manufacturers. So that's just an example. There are other examples of that as well. Last thing I want you to know about this topic here about comparables is that when the ROE of a firm is equal to the required rate of return on equity, then the present value of growth opportunities is equal to zero. And this is true for very mature firms. The ROE is equal to the required rate of return. When the ROE of the firm is greater, than the required rate of return on equity, then the present value of growth opportunities is greater than zero. All right, so that's going to be it for this video. I'll put a quiz online for it. And then the next video will cover the free cash flow and the dividend discount models approaches to valuing a firm. Please let me know if you have any questions.